People think I'm going to go into non-taxable state, Florida, invest there and save taxes. It's not true. If you live in California and you go invest in Florida and then flip in Florida, whatever you do in Florida, you sell the property, you make $100,000 gain. Florida might not tax you there because non-tax is not taxable state. California, you always have to pay tax in resident state. So if you live in taxable state and invest in anywhere else, doesn't really matter. There's no benefit from investing in any non-taxable state, or 9 or 10 of them. Now let's reverse that. If you live in non-taxable state like Florida and then go invest in California, New York, same scenario. California is always going to tax you because it's the instant nexus rule. The income was sourced to California, you sold the property, you flipped the property, you made $1 million there, California is going to tax you there. So you always have to report income in the state where you make it at the state level. So you always get taxed. So the only way to not pay taxes is if you live in that non-taxable state and you invest in non-taxable state, then you'll never pay state taxes. Federal, obviously, you have to always pay. So very simple, right? Taxable, non-taxable, or vice versa, doesn't really matter. You're always going to pay tax at one level. If you live in non-taxable state and invest in non-taxable state, that's where you avoid state taxes. Now, what happens if you live in both taxable states? Which state tax do you pay? You pay the highest tax rate. It's that simple. You live in New York, you invest in California. Whichever state has higher tax, you pay tax, you get credit. Okay, it gets complicated, but just think you pay the highest tax of both states. That's all.